This video, I want to consider how political uncertainty drives market volatility. How does political uncertainty impact market volatility? So we consider number one here, uh, increased investor uncertainty. Number one is increased investor uncertainty. So in this case, we consider market reaction. And so we discover that political uncertainty often leads to increased volatility as investors become unsure about the future direction of economic policies, of taxation, and in government regulations. This uncertainty can cause sudden shifts in stock prices as investors react to news, they react to rumors, they equally, react to a potential policy change. We also consider short-term market swings. In this case, during elections, political crisis or transition, market may experience rapid, price fluctuations as investors assess the likelihood of different political outcomes and their potential economic impacts. You discover that investors are very sensitive to the overall political and economic climates, and they tend to react accordingly. Number two is unpredictability of government policies, the unpredictable nature of government policies. So in this case, you consider fiscal and monetary policy changes. So political uncertainty can lead to unpredictability in fiscal and monetary policies, such as changes in government spending, tax laws, or central bank actions. Market typically dislike uncertainty. The market doesn't like uncertainty because it keeps investor on edge, and as it makes it difficult to project future earnings growth or inflation rates. You also need to consider regulatory changes. As if there are expected changes to regulations in key sectors like healthcare, like energy or finance. The uncertainty about how this will unfold can lead to a sharp market reaction. So especially if there's ambiguity about how policies will be implemented. Not just the policies themselves, but how are they going to be implemented. The implementation will certainly affect how investors would react at the end of the day. Number three is impact on business confidence. Impact on business and confidence. So in this case, we consider corporate decision making. Political instabilities can now lead to hesitation among businesses regarding expansion, regarding investments, and also when it comes to hiring. So this lack of confidence in the political environment can reduce market optimism, triggering increased volatilities. And as investors react to slower growth prospect, they believe that considering this particular decision, it might affect growth negatively, and there could be a dampened growth prospect. You also have lower corporate earnings. You discover that political uncertainty can hurt corporate profits if it leads to higher taxes, stricter regulations, or disruption in the supply chain. When these factors come in, discover that it will then, trigger investor reaction, which can negatively impact the markets. And we discover also that in the case of lower corporate earnings, investors may revise their expectation for maybe their expectation of profits or growth or earnings, and this would then contribute to a greater market fluctuations when they feel that the company may not really do as well as expected, and that could lead to them, selling their shares and exiting the market. Number four is geopolitical events and global impact. Geopolitical events as well as global impact. And so global threats and diplomatic relations in this case, are factors you must consider. Global threats as well as global, there's we want to consider how geopolitical events and its global impacts, kind of. So in this case, you consider global trade and diplomatic relations. You need to consider the fact that political uncertainty in one country can have a global implication, particularly if the country is an economic powerhouse or plays a significant role in international trade. If anything happens to the U.S. economy, to Chinese, to the Chinese, or affect the Russians or other, prominent countries like that, definitely it will have an impact, in how investors perceive, global investing, and so incidents like trade wars, sanctions, or what they call it, tariffs, and also a shift in diplomatic relations can disrupt global markets and increase volatility. In a case where two countries are no longer in friendly terms, it will affect trade between them, and that will invariably, influence the stock market negatively. This risk of conflict we should also take into consideration. Risk of conflict. So political instabilities it can heighten the risk of military conflict or civil unrest, which tends to trigger broader market volatility as investors react to potential geopolitical risk. So that reaction is certain. No matter what happens, investors will react accordingly. Please like this video and subscribe to this channel if you've not done that. Number five is investor behavior during political uncertainty. How do investors behave during political uncertainty? So in this case, we consider flight to safety. They will flee, they will run away to a safer environment, a safer political atmosphere. And so in times of political uncertainty, investors often seek safer assets such as government bonds, gold, or defensive stocks. This shift can cause decline in riskier assets like equities, particularly in sectors exposed to political risk, thereby increasing market volatility. The more people flee from the market, the more the market becomes volatile. And so we also consider speculative trading. So uncertainty often leads to increase in speculative trading as investors try to predict political outcomes or react to news. Some people are just there with the purpose of benefiting from uncertainty. When other people are fleeing the market, some people are just there calculating, strategizing on how they can benefit from this uncertainty. That's what traders do. These speculative activities can amplify price swings and contribute to market volatility. So when speculators come in, they will tend to destabilize the entire market. That is how they trade. That's how they behave. Number 10 is a long-term effect. Number 6, rather, long-term effect. In the case where you have prolonged uncertainty, and so if political uncertainty persists, it can have a lasting effect on the market sentiments. Prolonged uncertainty, such as in situation involving ongoing political gridlock or instability, it can dampen economic growth, growth expectations, and which can lead to sustained market volatility. Definitely, it can lead to prolonged volatility in the markets. And so you also, take into consideration recovery post uncertainty. Uncertainty does not last forever. Whatever have a beginning must equally have an end. Okay, so how do you handle the end of it? So we want to consider recovery post uncertainty. Once political uncertainty is resolved, markets may stabilize and rebound as clarity about future policies and economic directions emerges. However, the immediate aftermath of political events may be marked by heightened volatility as investors, digest the changes. As investors process what is happening, they will certainly react accordingly. Some investors believe that the prevailing condition will not persist forever, and as people are dumping their shares because of instability, diligence, risk, risk taking kind of, uh, aggressive risk takers are silently buying. As people are dumping, they are buying. They believe that eventually, the economy will stabilize. The political risk will no longer be there, will fade away, and then they will then reap a higher stock price when the market corrects or when the market rebounds. After the prevailing uncertainty is no longer there.